Hi traders, welcome to this edition of Expert Market Analysis brought to you by Errante. This is generally a bi-weekly review and preview, so every other week of the market's key events and trading opportunities. Whilst I just let you have a look at the couple of disclaimers you need to browse through, I'll just run through what we hope to get through in this webinar and also some of the key objectives of this webinar. We think markets are generally driven by themes which buyers and sellers relate to in order to enter and exit markets. So these stories or narratives can be long-term fundamentals or short-term themes that increase or decrease in importance over time. Our goal really is to break down all the market jargon and complexities that we read about. So if you do have any questions, please do ask them along the way, and I will try to answer them during that time, or at least after the webinar finishes. Okay, it's Wednesday, February the 7th. It's just after 11 a.m. in London, and let's get to it. Markets generally, well, at the moment, we're seeing a slight pause really in this dollar rally that we've seen, up over 3.5% from its recent lows late last year. So the dollar and really treasury yields really, which is what's been driving markets at the moment, they are, well, taking a breather so far today. Equities more choppy really, sentiment turned slightly cautious amid another plunge in that New York community bank stock, which we're now watching really. That's stoking fears a little bit about the regional banking sector in the US. And if we cast our minds back to March, obviously last year, when we had that big major shock around that sector, then just some fears around the recent results and what is happening in that sector. That is driving yields for sure, and 10-year treasury yields as well, which popped up above 4%, a key marker for us that we're looking out for, and went towards 4.2% actually, but now just turned around again, just on concerns again, as I say, about that regional banking sector in the US. Stocks in Asia, meanwhile, they came off their session highs as investors really weighed the impact of China's efforts to prop up the market, and really after several Fed officials as well have echoed Jerome Powell, Fed Chair Powell's signals that the Fed really is in no rush to ease policy. That's obviously a major theme that we've been looking at this year, and this major pushback between or against obviously early rate cuts, and especially that March rate cut. We'll look at that in time. Just to go through actually what we're going to look at. We'll look at just an interesting gap that is emerging in the Magnificent Seven. So those mega cap tech stocks which have driven the indices over the last several months. Just a couple of gaps emerging there. We'll look at some technicals around the S&P 500, the NASDAQ and the Dow, and just touch upon earnings at the moment. We'll then just really review what's been happening and the key drivers, as I said, for the markets recently. So that is, of course, last week's FOMC meeting, the Fed meeting, as well as then that Friday non-farm payroll report, which was completely blowout, to be honest. And we'll look at that and the graphics, and also then the DXY, so that's the dollar index chart, to see where that is now pointing. We'll also review the Bank of England meeting, really important for cable, so sterling against the dollar, and we'll look at the price action in that major, of course, as well as looking at Eurozone inflation data. That was out last week as well, a really hugely busy week last week, of course, with major risk events. So again, that impact on euro dollar, although certainly the dollar has been the driving force in the majors at the moment. And then hopefully, if we have time, we'll touch upon this week's RBA meeting as well and look at the Aussie against the dollar. So there's a wrap of what we hope to get through in the next half hour or so. Firstly, it is this gap, yes, that has been emerging in the Magnificent Seven. So as I said, those 7 mega cap tech titans, 4 of the 7 really have continued to outperform the market. And this chart nicely shows you that really. Alphabet, though, has lagged behind the S&P 500, this is. And then, of course, Tesla and Apple have been the 2 largest drags on the index. And you can see that with Google, Alphabet, that pink line, then the light blue line, Apple, and then Tesla really lagging and being a big drag on the index. Tesla, yeah, fallen so far actually that it's potentially fighting to hold on to its place among the top 10 most valuable companies in the US. Interesting, they have now all reported, apart from Nvidia, that reports at the end of this month, and that certainly you can see from the dark blue line there has continued to rise this year. I'm just checking, really, it's continued to rise up over around 30% actually this year already. Meta, of course, had that huge jump last week, up over 20% on its results. Yeah, closed, I think, up 20%. Just seen a slight pullback this week, which is fairly to be expected after such a sharp move. But strong quarterly results by them, 25% year-on-year revenue growth, earnings beat, share buyback, and of course that headline sort of debut dividend. Really sort of interesting about these stories about Meta and then generally these tech titans really coming of age in a way by offering dividends and not keeping this their huge piles of cash, which they do have, of course. Yeah, Meta, Microsoft, Amazon, anyway, they've doubled down on AI spending, but they have been supported by stronger sales and, of course, that dividend at Meta. Flip side, certainly with Apple, investors spooked really by weaker sales in China. Also, iPhone growth, whether that's slowing and by how much, certainly with flat guidance, I think, for the current quarter. And then Tesla, of course, all about that slowing growth that it's seeing and challenges as well from some of the Chinese EV makers, which really are moving into Europe, especially will be the case this year and are already moving into Europe as well. And that is, of course, the biggest market for EVs at the moment, aside from China as well. I think BYD, if you saw that headline recently, just saying it had shipped more vehicles than Tesla for the fourth quarter, I think. So interesting sort of longer term theme there and really interesting. We've been reading about that a lot actually, and this idea of course, Chinese car makers really shaking up the car industry in general and spreading their wings into other markets apart from China. Of course, who then is going to take the place of Tesla and some of these laggards then in the mega cap 7? Well, Eli Lilly, Berkshire Hathaway, which is of course Warren Buffett's company really. They've overtaken Tesla regarding market cap at least. And then just the wider theme around that then for us is then the breadth of the market, because that has been narrow. And if you think the S&P 500 was up over 4% this year already, drivers like Apple, Tesla and Alphabet now replaced, as I say, by Eli Lilly, Berkshire Hathaway and potentially as well Nvidia's rival AMD. So just this changing slightly of the guard. Interesting then that the equal weighted S&P 500, we talk about this quite a lot over the last few months, that would be up just 0.2% if it was equally weighted. And last year the top 7 really drove around 60% of the gains. But year to date, they've powered actually more than 80% of that increase. So yes, just a thing to watch out for us. It really interesting, and whether this Mag 7 sort of moniker needs to be tweaked somewhat going forward. Regarding earnings, half of companies have reported, well, had reported actually up until this week, really results mixed. S&P on track to eke out sort of year-on-year earnings increase of 1.6% for the fourth quarter last year. But if the Magnificent Seven again were excluded, earnings would actually be down 8%. And certainly it's been another big week of corporate earnings. They really will help us continue to help us determine the rally, of course, that we've seen taking stocks to record highs, whether that can keep on going. Certainly, as I mentioned, while most of the big tech headliners have already reported, still a huge batch of companies to come. We've had Eli Lilly this week, Walt Disney, ConocoPhillips, PepsiCo. And interesting with Eli Lilly, really said demand for a new class of diabetes and obesity drugs, which is obviously their key driver. Those will boost sales by 20% this year and push revenues up above 40 billion. Interesting, that stock was up over 6% in the grey market or after the close, but then closed very marginally lower on the day. So interesting, very overbought, it looks like technically on various timeframes with that stock. And interesting that obviously blockbuster earnings, but a negative performance on the day for Eli Lilly. S&P 500 companies really on pace to have increased fourth quarter earnings by over 6% year on year. That's according to LSEG data as of January 31st. So far, 80% have reported earnings above expectations, compared with 76% average beat rate of the past 4 quarters. So yes, we're still paying attention to any insight companies give about 2024, of course, and then really earnings expected to grow faster than in 2023. If I just double check, we'll just look at some of the technicals now, actually. Let me just pull up the first chart for us to check out, which is the S&P 500, which you can see here. I'm just checking you can see the screen. Just bear with me 1 second. Sorry, I'm just checking that you are seeing what I'm seeing. Yeah, just double checking you can see that S&P chart that I pulled up now from TradingView. Hopefully you can. I am seeing it, and I'm not sure you guys can see it just yet, which is slightly odd because I am just trying to pull it up for you, and it's here on my screen. So hopefully we've come off the Magnificent Seven chart that I've just showed you about that diverging performance. But it doesn't seem to be updating. I'm not sure whether you can let me know whether you can see this S&P 500 chart. Somebody who's on the call, there's a few of you, quite a few of you. So yeah, but I'll crack on just with the S&P 500 technicals really. Obviously we are at or very close to all-time highs, just pausing and holding off from that on the daily chart. Just looks like bullish consolidation really. We pulled back from overbought territory on the daily RSI, at least below 70 there. We're of course way above the moving averages, the 50-day moving averages down at 47.40 or so. So yes, whether we stick with this obviously very strong dominant bullish trend, just noting that the recent high is obviously at 46.75. And if we pull to the weekly chart, that previous high is at 48.18. So that may offer some support if we do pull back slightly. We are overbought actually on the weekly chart, on the weekly RSI above 70.72, just above that. So interesting whether we do get a pause and a pullback slightly, certainly with some of these results that we're getting. I'm just going to check out now the Nasdaq, very similar charts, consecutive weeks of gains, and just a couple of pauses really, but we're at obviously very close to all-time highs again. That high from last week, closing high 17,682. We're just below that now. We've just paused over the last couple of days. We did make a new intraday high. Looks like yesterday at 17,680. But just pulled back to 17,572 the close. So again, bullish consolidation looks like. We've got in here a fib level just of this move, this year-to-date move really in the well, the first fib level is below at 17,331. So yeah, bullish consolidation to us. We're not overbought on the daily. Weekly, we are overbought on the RSI at least, and a couple of other momentum indicators. So interesting whether we get that pullback or this strong bullish trend just continues. Okay, just looking at the Dow as well. Again, overbought on the weekly. You can see consecutive weeks of gains. So slightly overbought on the weekly and just pulled back obviously from that close from Friday at 37,783. Again, as long as we keep sort of probably 38,000 or so above that, then this is just bullish consolidation before we make another new high. Okay, that is stocks for the minute. We'll get into last week's main events now, which of course were firstly the Fed. So just pull up a graphic with all the useful information. Hopefully you find these really helpful. Yeah, the Fed meeting, of course, rates were kept unchanged at 5.25% to 5.5%. But key really was they removed, well, that wasn't key, it was really expected. They removed the tightening bias. That was widely expected, of course. But the Fed does not expect it will be appropriate to cut rates until there is greater confidence inflation is moving sustainably towards the 2% target. The Fed said recent indicators suggest that economic activity has been expanding at a solid pace, and that was previously slowed from a strong pace in Q3. And the committee judged that the risks to achieve its employment and inflation goals are moving into better balance. So that was slightly positive from the statement. They also stated, actually, in considering any adjustments to the target range for the Fed funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. For us then, Chair Powell also acknowledged the policy rate is well into restrictive territory, and they have been seeing effects of economic activity and inflation, which he noted actually that the policy rate is likely at its peak for this tightening cycle, and it will be appropriate to begin reducing rates sometime this year if, of course, the economy evolves as expected. Then in the Q&A, Powell he said almost everyone on the committee believes, again, it will be appropriate to reduce rates, but in the base case where the economy is healthy with a strong labour market, of course, the Fed can be careful as they think about the rate cut timing. Crucially, and really interesting actually, that he explicitly said about a March rate cut, he does not think that is likely. Not the base case for the Fed, and said, of course, it is to be seen, but does not think the Fed will have enough confidence by March, while they will be data dependent, taking decisions meeting by meeting. Really interesting then, of course, we've had this blockbuster non-farm payroll report we'll just run through shortly, but the data, yeah, is encouraging for the Fed. Many economists really recognizes really the Fed's, well, the credibility is kind of online at stake really. They were damaged by their assertion obviously a few years ago about inflation being transitory, only to have to obviously rapidly reverse that course with significant rate hikes through 2022 and 2023. So really the last thing the Fed wants is to get it wrong again at a key turning point, and that is key. They don't want to loosen too soon, too quickly, and then of course reignite inflationary pressures. Certainly the statement acknowledged the economy has been expanding at a solid pace. I think is what they said. The unemployment rate just 3.7%, while equity markets remain close to their all-time highs, of course. Ultimately, the data seen so far has been good enough. So the Fed really simply need to see more similar evidence to start cutting. Interesting then, we did get backup from Powell over the weekend in the CBS TV show, the 60 Minutes. Nothing really new from Wednesday's meeting. He just backed the dot plot released at the December meeting, indicating the Fed expect 3 rate cuts, which we put in here, obviously 75 basis points of total rate cuts for this year. And of course, that compares with still around 5 cuts or so for 2024. Powell also emphasized again the strength of the economy, underlying strong jobs market, of course, and saying how the economic pain he kind of forewarned in Jackson Hole in August 22 may come with the following rate hikes in large parts, which has not yet materialized. We should note that that interview was filmed Thursday, so a day prior to the release of non-farm payrolls report. So, of course, that was blockbuster. If I just show you this interesting chart, which we are mapping courtesy of one of the investment banks, ING, but it just shows you the time lag between the last rate hike and then the first rate cut in the previous periods that we've seen. So going way back to the sort of mid 70s, there's 9 occasions, and the average is around 6 months. And if we just go back to here, of course, we've had 4 consecutive meetings where rates have been kept the same on hold. That equates to around 5.5 months or so. The average, as I say, is around 6 months. So we're potentially going over that, of course, through March and potentially beyond. Just before we get on to, actually, I just want to show you the CME Fed Watch tool. Hopefully you guys use that. We've used, highlighted this over the course of, since we've been doing this webinar, really. So this is the CME Fed Watch tool, which basically shows you Fed funds futures rates and essentially analyzes the probability of the FOMC rate moves for their upcoming meetings. So essentially they use 30-day Fed funds futures pricing data, which have basically been relied on to express market views, of course, on the likelihood of changes in US monetary policy. So a free tool for everyone to use, basically pricing off Fed funds futures, and you can see the different Fed meetings here. So the next one, 20th of March, not till then, nothing in this month, and then a break obviously in April as well, before then the 1st of May meeting. And you can just see really nice way of putting it. The chances are given of a Fed move currently at 5.25 to 5.5%. So just a 20% chance or so of a rate cut, a 25 basis point rate cut in March. And you can just see then as well the historic, what we have seen previously a week ago, that was above 50%, and even then a month ago, start of the year, we were 64% chance. So, and it was even higher than that actually at the start of the year. Pretty much nailed on for a rate cut at the March meeting. Now only a 20% chance of that happening, and I think that went down to 15% or so intraday yesterday. Whereas May is now more likely to get the first cut, although interesting again, that is only around a coin toss chance, just above 55% for that move. So again, markets very much readjusting their sights on the first rate cut. If we look at then June, yes, if you add those up, then yeah, very likely to get a rate cut, of course, by June. But again, going back to May, 55-45 sort of chance. No, well, sorry, I should say a bit higher, because obviously there's a chance of a 50 basis point cut. So around a 65%, 66% chance, 2 in 3 chance of a rate cut actually now in May. So a really interesting tool. We use that quite a lot just as a guide for where money markets are pricing Fed funds, which obviously then drives treasury yields, which drives again the dollar, and of course lots of other markets. Okay, just want to then move on now to that the NFP, which you can see here again, a nice graphic of the key numbers. Just to recap then, came in way stronger than expected, 353,000 jobs against a consensus expectation of 185. December job numbers as well, they had a massive upward revision actually to 333,000 from 216, and a total actually with November's upward revisions, a total upward revision is between those 2 months of 126,000. Unemployment rate that remained unchanged at 3.7%. Remember, record low is around 3.4%, so not far off that still in this cycle, in this late period really in this cycle. We've still got an unemployment rate below 4%. I've put in here the Fed expects the unemployment rate to be at 4.1% by the end of this year, just for your guide. On the wage front, average hourly earnings, they grew by 0.6% month on month, so that was twice the rate expected. That corresponds actually to a 7% annual increase, which really does not align with, of course, a 2% inflation rate. All in a blowout report, really. Job gains in a wider spread of sectors as well. Interesting, economists really pointing to, well, last year when 80% of jobs created were in basically 3 sectors: leisure and hospitality, government and education, whereas this report seen a much wider spread of in different sectors, and really all adds to that theme that the Fed is in no hurry to cut rates just yet. A couple of caveats to this report, I would say. A lot of the jobs are added are part-time jobs, and also the average work week did fall to 34.1 hours, which is actually in pretty much recession territory. As well, the household survey, so not wanting to get into too sort of economic detail really, but there are 2 surveys with the non-farm payroll report: the establishment survey of employers, which generates the payrolls number, and then the household survey that generates the unemployment rate. And that survey, the household surveys, showed employment falling 31,000. So that sort of goes in line with other labour market surveys, which have been much weaker. So the ISM manufacturing, the ISM services, they're in contractionary territory, which does point to job shedding going forward. So yes, that's the NFP. Just here again, you've got a chart just showing the different headline, the payroll change as the bar chart, and then the 3-month average, which is now picking up and way above 200,000. Yeah, really interesting set of data of course, after the mildly hawkish, of course, Fed meeting on the Wednesday. The NFP came out of course on Friday last week. Since then, we have had ISM services for January. That surprised again to the upside. The PMI came in at 53.4 against the prior 50.6 and expectations of 52.1, so stronger than expected. All the major components, prices paid, new orders, and employment index all came in higher than the December print. And the upside surprise really then, it aligns with most of the recent US data releases, which have all surprised to the upside. And that sort of compares with other geographical areas, certainly China, Europe as well. US really surprising over the last few weeks, especially with much stronger data than expected. If we just look at the DXY chart now, which is of course the dollar index chart, I'll just pull it up here. Yeah, up over 3% now, was up over 3.5% from this low in late December, as I said. Track sideways for a lot of January. We always say that if we get range contraction over a period of time, then certainly we do then get a strong burst range expansion following on from that. We did track probably longer over a longer period, tracking sideways than we'd probably hope. So sort of the consolidation pattern slightly negated. We did then actually though get that big range expansion on the non-farm payroll day, broke up to the upside through that 200-day moving average as well. That's at 159, that black line. and then above that recent range highs. We got above the 100-day moving average as well. That's the grey line. Just sort of capped the upside at that major fib level of the autumn decline, if you like. That's the 61.8 fib level at 104.63. You can see that's capped the upside a couple of times on the daily at least. So watch that for resistance. We've just rolled over now, just below the 100-day, and we're back to potentially the halfway point of that decline, which is at 103.86. So we'll watch that level for support. And then below that, we get back towards the 200-day moving average at 103.59. Okay, that's the DXY and mainly the dollar area that we want to look at. We'll now look at, just bear with me 1 second. We'll look at the Bank of England, obviously from last week again. And the graphic here with the main numbers that pretty much they were looking at, the MPC, they obviously opted to stand pat on rates like most other central banks. They kept the base rate at 5.25%. However, the decision to do so was really interesting, actually unexpectedly a three-way split, basically with Haskell and Mann, a couple of the MPC officials voting for a hike, as they have done over many months, whilst Dingra as well supported not as well, but she supported a 25 basis point cut. And really, this type of three-way split, quite rare, last seen in August 2008, actually just before the great financial crisis. The policy statement, well, that saw officials ditch prior guidance that further tightening could be required. No surprises there, of course. However, the MPC did maintain that the judgment, the judgment that monetary policy will need to be sufficiently restrictive for sufficiently long and for an extended period. That was hawkish, really, more hawkish than some had expected. We did expect that actually to be kept in there, to be honest. The accompanying monetary policy report revealed that the bank now expects inflation to reach its 2% target in Q2 2024 versus previous sort of Q4 2025. That being said, the key again that we were looking at, economists looking at as well, the 2-year inflation view, that's the medium-term view, more important really for markets, that was set at 2.3%, so above target. And then that really suggests that policymakers think the current market pricing is too dovish to be compatible with its inflation mandate. That was key for us. Then at the follow-up press conference, Governor Bailey, he noted that inflation is, well, it's heading in the right direction, but is not there yet. I think is the words he used when it comes to lowering rates. He also noted that the MPC does not need to see inflation back at target to cut rates, just needs to see evidence that it is heading back to target. With regard to sort of follow through of prior actions, Bailey remarked that so far 2/3 of the impact of prior tightening has been felt, so still more impact to come. And then, of course, when it comes to the MPC eventually lowering rates, Bailey was careful to note that even if rates were cut, policy would still be restrictive. So overall, really, they're in wait-and-see mode, really. It seems like the Bank of England, via its macro projections, really suggest market pricing perhaps too dovish at the moment. And then despite initially moving, well, the initial reaction was more hawkish. Market pricing pretty much sort of crept back to pre-release levels. First cut price by June, and then sort of 50-50 for May. Versus probably 66% or so before the meeting, and now around 100 basis points of easing seen by year end. I've just got a chart in here with the CPI data just to reinforce that sort of stickiness around core still at 5%, still more than double the 2% target. Headline around 4%, although going forward we should say these levels are bumpy initially this year, but then are expected to drop quite sharply, as I say, going forward. If we just pull up the cable chart, just sorry, bear with me 1 second. which is here. That is the dollar chart. Here's the cable chart here. So yeah, really interesting actually that yeah, we have been trading again, tracking sideways through most of January, back to, well, over a month actually, back to mid-December. 126, 128.28, really this range. The high at 128.28, as you can see, late December. Then we just broke down through that bottom, the base of that recent range at 126, got down to 125.18, down through the 200-day moving average as well at 125.62. But then the last couple of days, we've just had a decent bounce actually. Sterling outperforming really other major currencies, and now we're back actually. Back in that range above 126, currently 126.33. So interesting couple of days, potentially a false break out of that range, and we're back into it again. Near-term resistance, possibly 126.77. That's the 50-day moving average there, but potentially back into this range, 126, 128.28. Just remember, going forward next week, we do get, it's mid-month, and as always, middle of the month sees a load of UK data. So we get the wage growth figures on Tuesday next week, key for the MPC and the Bank of England. And then we get, of course, CPI data next Wednesday. Really important again for the MPC, and services inflation. They highlighted that in the meeting last week. Services inflation and wage growth being the two key inputs for policymakers at the Bank of England. So just watch out for those next week. We do, of course, as well as a reminder, get US CPI next Tuesday, just to put it in the mix there. Okay, we will move on from sterling to now the Eurozone CPI data that was out last week. Headline and core pretty much came in line with signals from the country data. So the headline HICP, that rose 2.8% year on year, and the core inflation came in at 3.3% year on year. Overall, a print close to expectations, core slightly higher than the estimates. Euro area unemployment as well, that remained at record low levels in December at 6.4%. So all in, business surveys show that labour demand is still elevated, especially in the service sector, although it has come down a touch. These factors with large wage increases, they really highlight that service inflation as well in the Eurozone is important, and due to structurally tight labour markets is still a worry for the ECB. So encouraging data, core data really coming down, but again, policymakers at the ECB worried about services inflation as well, due to obviously this tight labour market. You can just see a chart here of the core and at the headline rates coming down, and really why markets did price in a first rate cut quite early on, but then we had that pushback a couple of weeks ago by the ECB. Probably though, officials will remain cautious to that first rate cut, as I said, due to those upside risks to inflation from services prices. If we just move on to euro dollar, which I'll just pull up the chart here. Yeah, we've had this sell-off, of course, mapping really that DXY index. If you just think the dollar index weighted heavily by the euro, 56, 57% or so weighting in the DXY. So it's basically a reverse of that chart. So we had those highs as we did the lows in late December in the DXY, highs at 111.39, and then we've fallen quite sharply down to that recent low, actually recent low yesterday, 107.22, but now just slightly picking up from that. We've got the 100-day moving average at 107.84. We've got then the midpoint of the Q4 rally, which is at 107, just below 108, 107.93, the midpoint of that rally, and then just above that, then we'd possibly get into this sort of range, back into the range with the 200-day moving average at 108.34. Okay, just checking there's no questions around, which is good. Hopefully everything's been clear to you guys. Please, if you do have any questions, do ask them. I'll just touch upon now The Aussie dollar, of course, we had the RBA meeting on Tuesday. They kept rates unchanged as expected, but they struck probably a slightly more hawkish tone than expected. Rates, as I say, kept at 4.35%, but they highlighted lingering inflation risks. Sounds like a similar record, really, and we should highlight this, but similar to the Bank of England, similar to the ECB, the RBA highlighted inflation risk coming from the services sector, so from wages. Prices in the latter, well, they did ease more gradually than expected in November, but that contrast in developments in goods area, and again, that's in part due to the labour market being tighter than what is consistent with sustained full employment and inflation at target, despite those conditions having eased further. So both the headline and core in Australia in the Q4 last year dropped more than the RBA foresaw, but Governor Bullock at the press conference pushed back against those calling the November rate hike a mistake. Instead, she and the RBA statement explicitly kept the option open for further tightening if needed. Of course, the twist probably comes even as GDP and CPI forecasts were revised down a little over the horizon, but inflation isn't expected to reach the midpoint of the bank's 2 to 3% target before 2026. Money markets then, they stuck pretty much to their pricing of a first cut by August now, and the Aussie, well, that did find a bid along with sort of the dollar selling off as well in Aussie dollar. So we got down to a low of 64.86, and we're just picking up now back towards, well, the 100-day moving average, so that's at 65.32, and then we have sort of this range trade again, similar, plus the 200-day moving average, which is at 65.72. So those are the levels in the Aussie. Quite a week this week, really. We do have China CPI data out overnight later today, which will be of interest certainly to Aussie traders and the market in general. And then certainly, we have Canada jobs actually on Friday. Before then, a load of data, as I said, out of the UK next week, as well as that all-important US CPI data, which comes out next Tuesday. Okay, really hope that's been of use to you guys. It's great having you all on the call from so many different areas around the world. Really appreciate you dialing in, and we will speak to you in a couple of weeks. Okay, take care out there, and we'll speak to you soon.